Brian, thank you for joining Hollywood Times this morning. I want to get right to it. Tell us a little bit about yourself and maybe a little preview about your background, and then we'll get right to the questions.
Sure. So I am the head of the residential lending department for Capital Bank Home Loans. I've held this position since summer of 2015. Prior to holding this position as the leader of Capital Bank Home Loans, I was actually a mortgage loan originator for 17 years, where I progressed from, overseeing just myself to leading a small team to leading a whole division to ultimately being promoted to the leader of the whole Capital Bank Home Loans lending division, where I've been at Capital Bank now 9 years. And so, our department delivers plus or minus about 1.3 billion annually in closed volume. And that's the group that I'm a leader of. But more importantly, for the first 17 years of my career, I was a salesperson like those who I'm leading today. And so I understand the challenges and the stresses that mortgage loan officers go through. But I also understand from a consumer point of view what's important to them in becoming educated about home loans and home purchase, or possibly considering utilizing home equity for solving financial challenges or making investments and that sort of thing. So I bring a lot of real practical experience to my management of the whole division now.
Wonderful. Great. So you got an extensive background, and you're really dealing with, the general public, and I'm assuming all income levels, with regards to home purchases and loans.
Yes, that's correct. At Capital Bank, it's easy to do a loan for a person that's well qualified, has great income, has, ready down payment money, that sort of thing. But as a community bank, which is what Capital Bank is, one of our missions, and I think it's the mission of all community banks, is to serve the immediate community and businesses that surround the circumference of where its banks are located. So to that end, our banks are located in the District of Columbia, in Northern Virginia, and in different parts of the state of Maryland. So we have a real focus at our bank on community lending, and community lending generally touches individuals that might be considered low to moderate income. So we are very creative in the way that we put together loan programs and couple them with grant money that might be from different not-for-profits that are there to promote home ownership, and other government programs that are established to promote home ownership. And really, that's something that we're super proud of at Capital Bank. I'm not sure if that's something that we're going to talk about in today's interview, but I wanted to establish that, because to make a loan to a very qualified person, as I mentioned earlier, that's easy. Anybody can do that. But to have a whole division that's been recognized nationally by the American Bankers Association for a small bank, which is what I work for, as far as the amount of community lending that we do and our creativity in doing such, is really that's something that I'm super proud of, and I know the bank is as well.
Wonderful. Yeah, I definitely have a preference towards smaller, more regional banks than, say, banking with one of the like Wells Fargo's or Bank of America's. So great work. I'm sure you guys are doing. But thanks for that background. Let's get right to the heart of the topic today, which is you guys are kind of putting out there Hey, let's talk about this forgotten option for a lot of a lot of the public, which is the 20-year loan versus the 30-year loan. So tell us a little bit about that, and maybe just I know when everyone kind of just defaults to the 30-year, but there's a lot of benefits you guys had laid out for the 20-year loan. What are those benefits?
Sure. So just to kind of give you some background and just explain like the mentality of taking a mortgage loan. So oftentimes as a young person coming up and thinking about buying a home, we talk to our parents. And depending upon the age of your parents, they probably learned, about mortgages or some amount of information about mortgages from their parents. So if you step back 2 generations, you're really ending up in the times where the United States was going through the Great Depression. I don't think you would disagree with me going back 2 generations. And so during that period of time, and I've spent some time kind of understanding the psyche of the consumers that I deal with when I was a salesperson, and it works really good to use this to help my salespeople understand, kind of the perspective that a consumer is coming from. So if your advice came to you from your parents, and their advice came to them from their parents, and their parents were subject to the financial hardship and turmoil that occurred during the Great Depression, more specifically with mortgage lending, I'll explain to you what happened back then. The typical loan that was taken pre Great Depression time was generally a short-term balloon or an ARM. Okay, it was not a 30-year fixed rate loan. It didn't even exist. And so as a result, when all of these banks or lenders started losing their money because the stock market completely crashed, and of course, unemployment went sky high, there was a feature on those loans that the bank could demand the money back immediately, called a call
Mm,
feature. They could just call it whether you were in default
wow.
or not. Okay. And so, as a result of individuals experiencing literal homelessness, not to any fault of their own during this period of time, um, the next generation was taught that the safest and most predictable loan would be a fixed rate loan. Well, at that time, when fixed rate loans came out because of government regulation and they eliminated the balloons and the call features and that sort of thing, the gold standard in fixed rate loan was the 30-year fix. So that's what our grandparents, you and me, that's what our grandparents were taught from their parents, okay? And so no, so when a younger person today is coming up and they're ready to buy their first home and they ask their parents, "What should I get?" The automatic thing that rolls off their tongue is a 30-year fixed. They think about it from a safety point of view, but they don't even realize that, that they may be setting their child up to pay way more in interest and to accumulate far less wealth. And even though I'm in the
So
banking
before you
business,
continue, what makes the 30-year a safe? You said safety. Why is that safer? I mean, I understand, you're locked into a rate, but isn't the 20-year this same way?
yes. So let me explain why I use that term. Um, so the consideration of the unsafe loan, the loans pre-Great Depression,
Like the
they were
calls, the
primarily
balloons.
they, balloons or adjustable rate mortgages.
Hmm.
Okay. So the next generation of loans that came out to provide protections to the consumer was the fixed rate loan without the call feature. Okay. And the typical fixed rate loan, even though there may have been other products available, was the 30-year fix. So when weighing the difference between an ARM loan or a fixed loan, regardless of the term, its safety is in fixed, risk is in ARM. So that's really what I meant. Okay. Although, just, in full disclosure, I don't necessarily consider an adjustable rate mortgage a risky loan. It really just depends on the consumer's, time horizon and what they feel they'll do with the ownership of the home, after a given point in the future. Because one thing to take note of, which I was going to mention, so like I said, when the younger people are asking their parents for advice about loans, they're coming from, let me tell you, you got to take the safe loan, a fixed rate loan, and the fixed rate loan that rolls off their tongue is a 30-year fix. The parents don't think about what are the financial implications of this advice that I'm providing to my child, okay? And the reality is, on all mortgage loans, the interest is stacked at the front of the loan, not at the back of the loan, okay?
Yes.
So each and every payment has a particular relationship between interest and principal, and so that's called an amortization schedule, okay? And so you could look, when you take a loan, let's say a 30-year fixed, 360 months, you can ask your loan officer, please give me an amortization schedule, and it will give you 360 separate payments, which will show exactly what the relationship is between the principal and interest on each and every payment. So the point being is that financially, a 30-year fixed is, give or take, 90 to 95% interest. Some of it is interest rate driven. So if the interest rates are higher, the relationship between principal and interest is a little bit more in favor of interest versus principal. And if the interest rate is lower, you might get 5% principal in there versus 95% interest. Okay. But to come back to the safety question, it was just ARM versus fixed is why I answered that. But
so I guess the bottom line, Brian, is that the 30-year was the first product, and at that time the 20-year did not exist. Is that what it is?
I can't comment with 100% certainty whether it did or did not exist.
It was just not commonplace.
It wasn't commonplace. And so the point that I'm really trying to make to you and to the other, I've been interviewed on this topic more than once, okay? And the point is, most loan officers, for whatever reason, don't take the time to really explain the pluses and minuses of different loan options that could be available for the consumer. And I think that education, both about buying a home, taking a mortgage, but also taking a mortgage and how that works towards accumulation of wealth over time or loss of wealth opportunity over time. And I think that that's a big piece in mortgage lending that's missing. I believe, and so that's really the topic. The topic isn't, you can decide what the topic is, but I don't think the topic really is 30-year versus 20. I think it's more that, in our industry, in my industry specifically, individuals don't take the time to really understand the long-term and short-term goals of the consumer that we're serving. We just literally answer the phone and they say, I would like to become pre-qualified to buy a house. And I say, what's your income? What's your social security number? Blah, 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 blah. And I'm like, okay, you're pre-qualified. And, this is what the 30-year payment's going to look like. Well, I'm not really selling. I'm acting like you're just grabbing things off the shelf. And so it's the education is why this loan is really not spoken about too much. And I think to the detriment of the consumers taking loans, I think that's a real tragedy that's occurring. And that's
Yeah,
really
no,
my point.
I appreciate what you're doing, because yes, I think my experience definitely with the banks during the home purchase process is that aloofness, the not really seeing or helping me through the process as the buyer, to understand the process, and ended up having to figure a lot of that stuff out myself. But
Well,
yeah, I was gonna ask you, what is the reason why, and I totally understand that, it's going to be very interest heavy in the first few years. The bank's going to protect their interests, so the interest payments are stacked, with a higher higher payout of the interest than the principal in the early years. But why such a big difference with if you look at the amortization schedules of a 30-year versus a 20-year? Is it just because there's a lot less interest being paid because the loan is out there a shorter time? What's the reason why? I think the numbers that you cited is, you're paying as little as 5% on a 30-year, in the first 5 years, and then
yeah,
with a 20-year, it's more like a quarter or 30%, which is a pretty big difference. Can you speak
yeah,
to that?
sure. Yes, absolutely. So, let me give you some information that might add some color to whatever it is that you put together to present to your audience. Okay. Historically, I know you've heard of Fannie Mae and Freddie Mac, right?
Hmm.
Okay. They own over 7.2 trillion dollars of the mortgage float that's out there in the United States. Okay, it's an astronomical number, 7.2 trillion. Okay, they publish statistics that you and I can go look at any time that we want. Do you want to know? Well, I'm not going to ask you a question. I'm just going to give you facts. Historically speaking, in that whole servicing portfolio of $7.2 trillion, that portfolio turns over 80% of the time in 5 years or less. And if you move it out to 11 years, looking at the bell curve, it turns over 94% of the time. So what does that mean? That means that the average consumer, 80% of the time, refinances more likely or sells their home in 5 years or less at 80% of the time. And they either refinance or sell their home at 94% of the time at 11 years. But it's more likely refinance than sell. Most people aren't that transient, okay? So that means that 80% chance in 5 years or less, the average consumer is going to start over at the beginning of that amortization schedule. And they're just going to keep doing that. So of course, that's why when you drive into a city and you look at the tallest building that's there, you know it's got a bank's name on it. You know it does, because they make that much money. And I worked for a bank, and we're not a not-for-profit, but that just happens to be the way consumer behavior is.
Mm-hmm.
And so the point is, if a consumer is educated on the front end, and you ask the question, why is it that you get so much more reduction in principal over a 5-year period on a 20-year versus a 5-year period on a 30-year? It's very simple. The amortization schedule is a fixed and constant set of payments with interest and principal relationship. So if you start that fixed and constant payments 10 years in the future, 30 versus 20, it's going to be a better relationship between principal and interest. And I have real math here for you. I ran it before, which was based on the little marketing piece, I guess, that you got before this interview. But when I was talking with the PR company, I gave them an example of a 30-year fixed at 3%. That's a fairly typical rate today. based on borrowing $300,000, okay? The amount of principal that you get into the payment at $300,000 at 3% on payment number one is $515. Okay, sounds like a good number. I get, $6,000 a year paid down on my $300,000 mortgage. Sounds pretty cool, doesn't it? Okay, you ready for this? The amount that you get to the principal on a 20-year fixed at a slightly lower interest rate at 2.75 on payment number one is $938. So that's over, that's about $12,000 a year versus $6,000. That's 100% different. That's eye-popping. Would you agree?
And for the bank, then you guys are making less money, right? I'm assuming,
less.
right?
Far less. Yeah.
Yeah. So that's interesting. I guess I appreciate banks like yours that are actually going out with the interest of the consumer in mind versus the interest of the bank. I guess banks have taken a hit on their image in the public, especially with the bigger banks. So I appreciate that. So so does your bank, Capital Bank, go out and basically make this 20-year option very much known whenever a customer walks through your door? And the other thing I wanted to ask is the market is all about the instant grat, right? The whole I pay less, because you will pay less if you stretch it out that extra 10 years. How do you deal with that deeply ingrained consumer behavior, and what are some ways to break that rigidity?
Yeah, so that's a fantastic question, and the consumer behavior is problematic, and the consumer behavior is predicated based on all of the advertisements that we see on TV about all the fancy things that we should own in order to make ourselves feel better. That's a whole different conversation. But it is a little bit more challenging, because most people, like when they buy a car, they want, they don't even care what the price of the car is. They say, give me a $400 payment or a $500 payment. And next thing you know, they're stretching out the loan to 7 years and, whatever. And, and that's a problem. And so to break the cycle is really about fiscal education in the front end. Okay. And so I look at it like this, and I try and coach my loan officers that the more education, the less selling that you do, and the more education that you do with a consumer, the more sticky the consumer becomes to you as a salesperson. Okay, which is what we want to do. We want to be of service and provide great information, which will then lead to the customer wanting to transact with us rather than somebody else. So on the front end, when you're talking to a homeowner who is, thinking 30-year fixed, and they're thinking taking a new mortgage, again, coming back to this same example, that 30-year fix that I talked to you, and I know you're not going to get granular with putting in, figures and things like that, but the difference between the 30-year payment and the 20-year payment is $361 monthly. Okay, that sounds like a ton of money. Okay, and I'll annualize that. That's $4,333 extra that the consumer would be paying on a 20-year versus a 30 in that simple example that I gave to you. But when you take a few moments and you break this down to the consumer, and you say, listen, you're going to have $12,000 of mortgage interest annually that you're going to be able to take off your top line income. And if you're at 25% tax rate, between state and federal, actual tax after all benefits, okay, you're going to get to tell your HR department, to change your withholdings by $3,000 a year, straight off the bat.
Mm-hmm.
So $3,000 a year takes care of 75% of that increase in mortgage payment. Okay, number one, first and foremost, if you happen to live in a state that allows you to take your property taxes off of your income, not all states do that, but most do, then all of a sudden, by owning this house and spending that extra $4,600 a year that I just mentioned, that's already covered by the tax benefits. And so I present that to the consumer that there will be no material change in your income and cash flow if we take a 30 versus a 20. But let me tell you where the material change will be for you. And this is really where the kicker is. So the payments that we are taking out, which are 10 full years, assuming that a consumer actually stays in the home to term, okay, which may or may not be likely, but let's just say it were, okay? The amount of payments that the consumer will make if they take the 30-year fix, and I'm just talking payments, I'm not talking $65,000 in interest like you looked at, but actual payments of $1,265 a month for an additional 10 years. That's the 30-year payment. That's $151,800. What would you do with that extra $151,000?
Mm-hmm. Yeah, that's
Anything you want.
pretty amazing numbers. And then you said it was like 1261, I believe, if you do the 30-year, and then it's like 1600 for the 20-year.
It's 12. The exact is 1265 on the 30-year, and 1626 on the 20-year. Okay, just using 300,000 at 3% for a 30-year. And 300,000 at 2.75 for a 20-year. And those are real interest rates based on where the market is today.
Right.
So you'd make a payment of $361 extra each month in the 20
for a lot of benefits.
But
yeah,
for a lot of benefits, but it actually doesn't change your cash flow because of the tax credit that you get for the interest expense.
Depending on which state you're in. Mm-hmm.
The tax credit for the interest you get anyways on all states. Mm-hmm. Okay. But in most states, you also get to write off your property taxes.
Right. No, and so unfortunately, putting myself in the mindset of maybe someone who is less financially literate, the cheaper option, even though it's way down the line and it adds another 10 years and another $100-something thousand of payments on interest, most people will take that cheaper option, and that's the more attractive shiny object, right? And then the part of the pushback could be, well, I can refi, which is what most people do anyways. Like you had said, within what is the average, like 11 years, you said? So
94% will refinance in 11 years or sooner. 80% will do so in 5 years.
Wow, 80% in 5 years even. So what is your response to that, and the best way to educate especially lower income people to not get stuck in a poverty cycle?
Yeah. So again, it all boils down to math. I mean, it is just straight up math. And so a loan officer should not be an order taker. A loan officer should help its consumer with possibly the biggest financial transaction that they will ever do in their lifetime.
Amen.
To understand the benefits of using the home as an asset, as an investment, versus looking at it as a roof over my head that I just want to make the lowest possible payment. So when you're talking to, somebody who doesn't, especially in community lending, I mean, this is really where it's at. Those are the folks that really need the hand up. You know what I mean? And so if you can show them, like you say, what do you have in your 401k? And they're like, what's a 401k? but they want to buy a house, right? I'm not being funny. I'm being real. And you say, listen, you're going to buy this house, and this house is going to be your asset. This is your nest egg. Let's talk about, do we really want the lowest payment? Or are we okay with taking a payment that's higher than the lowest payment for the creation of wealth for you and the generation that stands behind you?
Very powerful, and great to hear that you have advisors that are conveying that. Well, I think that really kind of wraps up that portion of I think you got me sold on the 20-year, and especially someone like me that thinks long term. I'm willing to pay $300 extra for the idea that I'm not on the hook for a lot more money, and that the next 5 years of my life, I'm not going to be just basically working for the bank in indentured servitude. So
Yeah, for sure.
yeah, so yeah, it sounds like a no-brainer. So yeah, that's great. Now, anything else you want to? I know you're in this education mindset. Really, the people and communities, like you had mentioned, in poverty, that you're seeking to educate. Tell us a little more about what other things that your advisors go to the community with, and maybe certain financial nuggets of wisdom that our audience could hear today from you.
Sure. So there's a number of if we're talking, just consumer education, and more specifically at the community lending level, and I just want to make sure you understand that's just a pretty word. We call it the community lending because that's what we do. We're a community lender, okay? But anybody, like I said at least twice in this call, anybody can make a loan to a well-qualified person. Anybody can. And oftentimes, those individuals come in with their own set of education, okay? But at the community lending level, which is a completely different arena, because in all likelihood, those individuals, nobody in their family prior to them has probably ever owned a home, okay?
You're the first.
And very likely, nobody in their family has ever given them real financial planning advice. It's not always that case, but a lot of times it is that case, okay? And so we go out, we do community outreach every single week. Every Saturday, we're holding classes that help people understand about credit, because oftentimes, they grow up, it's a cash lifestyle. We pay everything
Yes.
with cash.
Free
we
money.
Don't believe in banks.
Yeah.
And so, they just don't understand, they don't fully understand how actually using a credit card is a good thing, because this world is founded upon credit rating. So we start with education about credit, then we progress from education about credit, we progress into the home readiness path. We call it the home path for home ownership. And we help them to understand where they are in their income level and how that relates to a roof that they can put over their head with the inventory that's out there. And so if they only want to learn about credit, that's great. And I'm happy to educate you. If they want to learn about credit and progress down the path to home ownership, there's a number of steps there too. But I would say 75% of the people that we talk to on these weekly get-togethers, and these are face-to-face and sometimes Zoom, depending on the COVID situation, but they're held in the District of Columbia. And 75% of the people that we talk to, in my business, we call it bankable. They're not bankable. 25% of them are, and they're bankable because they have proper credit, they may have proper income and the appropriate monies for closing and things of that nature. Those are the easy ones, okay? The other 75%, we work with them from, sometimes it's as little as like 3 months to get some things in order, to as long as 18 months or more, to kind of move them through that path. But if they have a desire to break the cycle of, not having a stake, putting a flag in the ground and saying, this is mine, if they want to break that cycle that, their parents and their parents before them and everything have had, we're here to hold their hand the whole way through. And it's difficult for me to say to you one specific thing that we do, because, man, we do a lot, and and that this world is primarily electronic, right? People can get almost anything from getting on their computer. Well, my office in the District of Columbia is stand in line only to meet face to face with my lenders there.
I love it.
And that's what they do. They sit knee to knee. And just so you know, there is one fella that works in the office. He's a Korean fella, but not primarily, besides Jatae Kim, who's a hell of a guy, it's all women. They're all immigrants. And the leader of the group is, she's first generation from Cuba. So she understands, and it's unbelievable. And so we really serve the Latino community, but we also really serve the African-American community there as well, right in Northeast DC, that immediate area. And I'm telling you, we've been recognized nationally for what we do. And it's hard to explain exactly what we do to get people bankable, but you would see their wall of fame. It's all handwritten thank you cards up there. I mean, It's unbelievable. Unbelievable. Seriously, it blows my mind what these women do.
That's wonderful. And yeah, thanks for changing lives. Thanks for giving us a little bit of a preview as to, the enormity of that process. I can just see, from a teaching perspective, you got to do it in chunks, and you got to do it. You can't do it all in one day. It's building that relationship for the long term, and being there to, first of all, break myths about credit, and then getting into that ownership mentality, which in itself, a lot of people are just used to paying rent. They're not thinking about, let me own a home and what that looks like. So great work you're doing, Brian. And, thanks for taking the time. Is there anything else you want to say before we wrap up? And I want to thank you for, sharing this with our Hollywood Times audience.
Yeah, no, I think we've covered a lot. I mean, we spoke a bit about the 20-year versus the 30, and we spoke a lot about the community lending. And I know that there's, probably, your audience, there's probably great people right there in, LA and in the different counties around that are doing this super work too. I'm certain of it. But, home ownership done the right way is really the opportunity for average people to get ahead, in this world. Because just taking, your job and you're just meeting your bills and everything else, think about that. You're spending your money, you're paying rent, and at the end of the month, there's a few hundred left, right? If you took that same money that you were spending on rent, but yet you owned a piece of property now, over an extended period of time, all of a sudden you've got a $2 or $3 or $4 or $500,000 asset that's all yours to give to your children, or to give to yourself, or to sell and say, my God, I've got $500,000 to retire on that you never thought you could have.
Yeah. It's amazing. And
it's unbelievable.
I love it. I love it. And this is the way, in a tangible way, we can lift communities out of poverty and help people in a very tangible way. So thank you, Brian. Let's stay in touch. I will shoot you a link when this article is up, and we'll also put this Zoom up on our video. So thanks again, Brian. And where can we find your bank online? for those who may be in your tri-state area, or sorry, it's DC, Virginia, Maryland, right?
Yeah, but we are a nationwide lender also, just so you know.
Okay,
So we lend in California also.
great. And what's the website?
But so it's www.capitalbankmd.com. So capitalbankmd.com.
Awesome. Thank you so much. And Ryan, have a wonderful day, and we'll speak to you soon. Take care.
See ya. Thanks for your time. Bye-bye.